Hey folks, Dan Frio here, the rate update. Today is March 12th, 2021, and the economy is starting to kick along. We're seeing, unfortunately, Treasury yields going up a little bit too high, too fast. But we have consumer confidence came in, and the producer price index came in, and it came in line. So we got news about inflation coming up. So don't go away. We'll be right back. Okay, so just want to comment on a few comments that I got. I had somebody kind of upset with me because they're like, Dan, I thought you said it's not a political channel, but you keep, hashing this stimulus package and all that stuff. Okay, so let's get away from that. Basically, my point of all this is when you're flushing the system with a bunch of money, okay, I know a lot of people need it. Okay, let's put it that way. So we throw a bunch of money into the system. What that does, it doesn't matter where you are in the world, this is just the basics on economics. You throw a ton of money into the system, it's going to eventually, not today, not tomorrow, but gradually it is going to devalue the dollar, and you're going to see rates and inflation move up. The 10-year Treasury is a big benchmark that people follow, and it's like a crystal ball on what the markets feel about inflation. And when we see the 10-year Treasury spiking, that indicates there's inflation down the road. So here's my analogy. Somebody's like, Dan, you're crazy. The numbers came out today and there's no inflation. I get it, guys. But if you walk past somebody that has COVID and they sneeze on you, you don't get COVID, you're not going to see the effects of COVID right there at the sneeze. It's going to take a couple days, a couple weeks for it to set into your system, and then you'll start feeling the repercussions, and then you'll test positive. So it's not like, okay, the stimulus package got cleared yesterday, okay, inflation today. Doesn't work that way. So my apologies if people are misunderstanding what I'm saying is we will 6 months down the road, 1 year down the road. I hope I'm wrong. I haven't said, I'll post a video a year from now and say, okay, guys, I was completely wrong on what's going on with inflation. I hope I have to post that video, but I don't think I'm going to have to. So let's get on to what happened with rates today and some of the backdrop on why. So at first sight, you're going to say, are you kidding me? Okay, but the MBSs are up 50 or down 52. Okay, so why do we follow this? So those that follow my channel on a daily basis, you get it. But the newbies, they're like, okay, what's UMBS? That is basically mortgage-backed securities. It's a bond. Okay, it's a bond that trades on Wall Street as an investment. You might have it in your 401k, you might buy it individually, but it is what's happening to the price of the bond that you pay for. As the price goes down, 52 is a big down. As it goes down, mortgage rates go up. Okay, that's how it works. If this number goes up, mortgage rates come down. Usually you'll start seeing differentials in rates once this number goes up or down about 8 basis points. Between 8 and 10 basis points, and then it'll start trickling from there. 52 is a pretty substantial move. Okay, so if you're not locked in with a lender right now, I highly suggest you have them monitor it. If you're working with us, we monitor it. Trust me, we monitor it. We probably locked our whole portfolio. Unless you've just come in right now in the last couple days, we probably locked you as soon as we call you or as soon as you call us because the market is kind of going nutso. But we locked in most of our clients right in here, right around this dip. So when I saw the reversal here, I put out a lock alert. So mostly all of our clients are locked unless you started within the last 2 or 3 days, and then you'd have to check with your loan officer on that one if you're locked or not. So let me just give you the basics behind how the bond stuff works. So how a bond works is, just to explain this, the lower the price of the bond, the higher the rate of return or the yield or your mortgage rate. Okay, I always say this in its simplest terms. Here's how this works. Let's say that bond has a maturity value in a year of $100. Okay, so you pay $100 for that bond. So you pay that price. and in next year you bought that bond for $100. Next year you trade in that bond and you get your $100 back. What's your rate of return, or what would be your mortgage rate on that? 0. You had no return. Here's what I'm getting at. Watch this one. So now the price drops. Okay, so today you're paying $50 for that bond. Okay, so the price went down. Next year, when it comes to maturity, you trade that bond in and you get $100. So you bought it for 50 and you cash in at 100. That's a 100% return. So your mortgage rate on that would be 100%. So do you see, the higher the price, the lower the rate. Okay, get it? So that's how that works. I hope you get it. All right, so now let's move on to what's really going on behind the scenes. Well, today we had some news come in, and it was, let's go to the economic calendar. We had the producer price index. This is what the Federal Reserve really monitors to see what inflation is doing. Well, the consensus was 0.5. We came in at 0.5. Awesome. X food and energy, because oil prices are skyrocketing right now. That's causing freight to go up, which causes food prices to go up, because when they get wherever the food is created, it has to be trucked to where it's going so you and I can buy it. What's going on there? Well, it actually went down. This will be revised, I can almost assure you, because oil prices are skyrocketing right now. So if you drove past your gas station on Monday and you drove past it today, there's probably a differential in how much you're paying, and it's probably up, and it might be up a substantial amount. Okay, producer price index year over year. So this is since last month, but year over year, where are we there? Well, the consensus was 2.6. Right now, we are actually at 2.5. Awesome. Okay, awesome. The Fed is looking at 2.5 as being the benchmark. So we're there right now. So now here's some interesting information too. This is Reuters, University of Michigan Consumer Sentiment. How comfortable people are with the economy. And they gauged it at 78. That's pretty positive. It actually came in at 83, which is really positive. So that being said, numbers right now in inflation are tame, or right where the Fed wants it to be. So that's good news. Consumer sentiment is good. Again, guys, with all this stimulus packages and everything else, it is going to devalue the dollar, and we are going to see an uptick in inflation. Now, I'm not saying it's going to go bonkers. It could, because we're in unprecedented times. With this passage of the pandemic bill, there's about $6 trillion in money that's been created and pushed out into the system. Okay, so here's what happened today. We come out of the gate, we did well, and then we deteriorated all throughout the day. And you can see right through here at 10:15, everybody kind of dumped and got out of the market, and then it kind of stabilized from there. Okay, so right out of the gate, we just crashed, and then it stayed from there. And that was basically, because the inflation numbers came in okay and everything else. But again, what we have to focus on, one of the big focus points here, is what the 10-year Treasury is doing. So here's comments that I'm going to get. Dan, you never focus on the 10-year Treasury. You say it has nothing to do with mortgage rates. And that is 100% correct. It is not a direct correlation with mortgage rates. Okay. However, it has a trickle effect, or it has a flow-through effect in investments. So let me put it this way. The 10-year Treasury, why people watch that, is once it hits a point of 1.5 or higher, the yield on the Treasury now exceeds the S&P 500 dividend yield. So that means people are going to start pulling out of the stock market and starting to get into Treasuries because of the high yield. Okay, that's number one. Number two, you have now between different bond classes, you have, let's say, the 10-year Treasury and mortgage-backed securities. Well, the 10-year Treasury yield far exceeds the mortgage-backed securities yields, so it's pushing even more money into the 10-year Treasuries. So that's why you're seeing a dramatic run in the 10-year Treasury and a crash, and you're probably going to see this float over Monday, Tuesday, Wednesday. One of those days we're going to have a pullback in the market. Basically what it's affecting in the stock market right now is the NASDAQ, the tech stocks. But we're also seeing a pullback in mortgage-backed securities because people are flushing into the 10-year Treasury. So hopefully that makes sense to you. But yes, I usually don't watch the 10-year Treasury because for the last year or two, it's been trading at a range of about 0.4 to 0.9, which nobody was investing in it because they would get more bang for their buck in the stock market. And then the second tier down was mortgage-backed securities. So hopefully that makes sense to you and for you. So now let's go on to what the average rates are in the country today. Now guys, these are not my rates. These are the average rates throughout the whole country. We're going to go over where they are today from yesterday, how they moved this week, and how they moved in the past month. So I posted the 30-year rates for conforming, jumbo, FHA, and VA. And they're posted right here. We don't have to go one by one, but that's basically where the country is on average in these particular programs. A one-day delta means a one-day change. So basically this one didn't change at all. This one changed by 0.01 on the rate. So this would have been, if it went up 1 basis points, that means that yesterday this was 3.15. We added one today, so now it's 3.16. So basically irrelevant. This one, irrelevant, 0.08, okay? So that means this would have been, it was down 0.08. Okay, so you take that. So I hope you get what I'm saying. That's a 1/100th of a factor. Again, this past week, nothing, okay? But out of the last four weeks, the past month, we're about a third higher, 0.33 higher on average than where we were a month ago, okay? That's a fast move right there, guys. That's a fast move. All right, so now let's get on to some headlines coming out there right now. If you have a second home or an investment property you're looking to buy or refinance, especially refinance, if you're looking to do that, do it now. Why? Is because Fannie and Freddie are coming out with hits to the rate to kind of put a halt on that market because they have too many second homes and investment property mortgages. It's far outweighing their portfolio, so they're trying to cut back on that. And what they're doing is they're adding what we call loan level price adjustments to the rate. So you're going to probably see a rate of about 0.5% here coming up shortly. You're going to see rates on second homes and investment properties probably go up at least 0.5%, if not more. So that's what's going on right there. So what I want to discuss too is and I'm going to do its own separate video next week, but let's go over the forbearance guidelines real quick with those that are interested. So this information is hot off the presses. So I accumulated from our underwriters and a lot of our investors, and also Google searched it for Fannie Mae and Freddie Mac, FHA, VA, and so forth. So forbearance, for those that are in it, you know what it is. So I won't explain what the forbearance is. So what's going to happen is when you're coming to the end of this, you're going to have 3 options that they're going to allow you to have. Okay, those options are going to be bring your mortgage current right now, make payments, additional payments for the next 12 months to bring you current, or add the balance to the back end of your loan, and it's interest free, which is good news. Okay, so here's the exit. We're trying to create an exit strategy for you. Okay, so let me put it in this way. There's going to be probably 2 functions to this. One, if your rate is in the 2s or low 3s, you're probably best off just kicking the can down the street, putting it at the end of your loan, and worrying about it at that point. Put it this way, don't even worry about it, okay? Just keep living. Live life, enjoy life, and worry about, pay that off 30 years from now, or 25 years from now, 20 years from now. But if your rate is 3.5 or higher, let's at least talk and give you an exit strategy or the numbers. And so here's what you can do. I'm going to go over based on what kind of loan you have, what your options are. So those options basically are, and let's go through that in a second, and then we'll cover some specific questions that you might have. So if you have a conventional loan, what you have to do is once your forbearance is up, you have to make 3 consecutive monthly payments. They have to be 3 months worth of payments as well. So you can't make 3 payments in May and that count for your 3 payments and then you can refinance. You'd have to make like April, May, and June, and then we can refinance you. Okay, so if you have a conventional loan, you have to come out of the forbearance and make 3 consecutive payments. Okay, we cannot finance the past due principal and interest So this would be basically considered a cash out if you were to add up all the back interest and everything into that loan. So just let's make it in the simplest terms. If you're in a conventional loan, your rate's 4% or higher, you have to get out of the forbearance and make 3 consecutive payments, and then we can refinance you. But in the meantime, if your rate is over 4, call us. Let's get you set up in our system, and we can monitor things as we move forward, because you have to make those payments before we can get a final approval and close. So let's say, for example, rates are moving up. We start you now and we lock you in for 60, 90, 120 days. Just say. And then after that duration, you've made the 3 payments and we can refinance you. We would love to do that. Okay. Now, FHA gets a little bit different, because if you're in an FHA loan right now, you can do what's called a streamline. The normal streamline does not require you to prove your income, nor do we need an appraisal. However, in this situation, we have to validate your income and your credit. We do not need an appraisal. So we do have to validate your income, and you have to meet certain debt ratio requirements. I won't go through that thoroughly because I don't want to confuse you in this. Basically, we can put you through the FHA streamline process as long as we can get you to budget. You can throw all of the back payments into the loan, all of the back interest into the loan, any additional fees that they might have tacked onto there. You can throw all that money into the new loan. What you can't do, or what we cannot do, is finance the escrow setup. So you might need, a couple $1,000s to do this, but once you do this, you're going to probably skip at least 1, maybe 2 more or additional mortgage payments. So if you're in an FHA loan, your rate is over 3.5, 3.75, call us, because there's a great opportunity for you here. Okay, so now let's move over to the VA program. VA is the easiest one to do. So if you're in a VA loan now and your rate is 3.5 or more, this is kind of a no-brainer for you. Basically, you have to finish the forbearance. So let's say you started last March and you're due this March. You get that letter and saying April 1st you need to start making payments. Well, call us, because you don't need an appraisal. We will need to verify your income, but we can refinance and throw all of the back payments, all of the back interest, all of the back fees, your current balance. We can throw everything into the new loan and start you off fresh. So that is the easiest program to fit you into. Now, the other program we have is USDA. USDA is similar to the conventional financing. You have to complete the forbearance agreement, and you have to make 3 monthly payments to your mortgage. So you can't 3 consecutive months, meaning you have to make a March payment, March payment, April payment, May payment, and then we can refinance you. So there is options here. But again, if your rate is over 4, please call us, because we'll run the numbers, see if it makes sense for you, and then we'll set you up in the system and get you prepared, so when your forbearance is up or those 3 payments are up, we can help you out. So that is the forbearance rules for today. So that being said, you're like, okay, Dan, how do I get you? Please do one of these things. All my information is down below. I got an 800 number. I got a proprietary website that's me. Don't go to preferred rate. Don't Google search me. Click the link down below. It'll launch you right to my website. There, you're going to get our 800 number. You're going to get a mobile app. You can apply online. You can find out a whole bunch of information on that website. In the meantime, please give me a thumbs up. Hope you like the videos. I got about 150 thumbs up yesterday and about 6,000 views on yesterday's video. Thank you guys so much. Please make sure to subscribe down below. Click the bell so every time I post a video, you get an alert. So let's get on to how you find me. And go to therateupdate.com. You can click here to get our mobile app. This thing is crazy cool. And you can follow your loan throughout the entire process. You can give us a call. This is probably the quickest and easiest way to do this. Give us a call at 844-775-LOAN. It's 844-775-5626. You can schedule an appointment right here. You'll get confirmations via text, emails. We'll set up a Zoom call with you and or a phone call with you to go over any and all questions you have. So you can pick a 15-minute, 30-minute, or 60-minute consultation. You shouldn't need 60. You basically will need a 15 or 30 depending on your situation. Or just go to the website and there's all kind of tools here. There's click here to apply right now and then. If you're like, I got some questions, I got, whatever, I'd like to talk to somebody, click here and we'll give you a call or an email back and get in contact with you at your convenience. Or if you want to answer some questions to help guide you as well as me into the perfect program for you, click this tab right here. You're going to answer between 12 and 18 questions. Based on those answers, it'll help me and you determine the program you fit into. And this one right here is for the refinance. So this is if you're looking to purchase a house, and this is if you're looking to refinance. So I want to thank you guys for watching today. Have a blessed weekend. Take care, be safe, have fun, and I'll see you on Monday. Have a good one. Bye-bye.